Welcome to another Stage Analysis members video. It's Sunday the 12th of March 2023. A lot to get through on the weekend video this week. It's been obviously a very interesting week in the markets with what's been going on. Lots of failed breakout attempts following the crisis in the banks that's obviously been heating up over the last few days with the collapse of SVB. So basically, that is ongoing. We've had a change of behaviour across the board with many stocks, and a lot of the short-term market breadth signals that we've been seeing over the course of the last month that were on defensive signals have got a lot worse, and we've started to see that move into some of the more intermediate and longer-term measures as well. So I'll cover that a little bit later in the video. I'll start off tonight's video with a look at gold actually first, before we actually get into what else is going on, the regular content, and have a look at some of the bank indexes, etc. Because gold, the dollar index this week is at the stage analysis potential secondary entry zone. It pulled back to its stage 4 area. It broke down and has started to roll over again, and in turn we've got gold attempting to rebound. Physical gold mined, not talking about the miners quite so much. Obviously they're related. They're gonna have relations to what's going on with the obviously stocks in general. So we're looking at physical gold here only in this regard. So I wanted to have a little chat about this as we're in the stage 2 secondary entry zone potentially with this. We've had a rebound. It did start to fall down a little bit during the week, but then I had a strong rebound into the weekend as the market softened into the close on Friday there. You see a rebound through here and potential secondary entry zone in the stage 2 area here. So we've come out after a short stage 4 decline back into stage 1, had this recent stage 2 breakout attempt back in the start of the year here, and now into that secondary entry zone. So something I wanted to talk about with this is that when we look at this, I'm looking at GLD here. So if we go into the performance chart versus spot gold, so actual spot gold, and then the GLD, and then some of the physical gold ETFs, then you can see there's actually a little bit of a disparity between them. There's not a huge amount. You would expect the spot them to track spot gold fairly well, and they're one of the better tracking ETFs. They don't have the kind of issues that we see in some of the other ETFs like oil and natural gas, etc. Gold and silver generally track fairly well, but you can see there is still a little bit of a disparity between them. This is a 200-day look at this, so going back to the middle of last year. You can see if we look at it on a performance data, you can see the Sprout physical gold, which is PHYS, it actually had a minus 1.37% disparity compared to the others, which have only had fairly minor differences. So spot gold itself over 200 days is up 0.1%. Then the Spider Gold, the GLD, is down 0.15%. And then you've got the Goldman Sachs, which is AAAU physical gold ETF, up 0.04, and the Aberdeen Standard here, which is the Swiss physical gold, I believe, which is 0.06. So what I wanted to look at with these is if we go into the individual ones here. So starting with a GLD here, if you look at the total dollar volume on this, you can see obviously this has by far the most in terms of dollar volume here, 4.539 billion on average for this, which is obviously very, very large on a weekly basis, and trades on a weekly basis there, $970 million volume there. So very, very large in that one. But this one has obviously counterparty risk compared to the others which are backed by physical gold. So if we look at some of the other ones, so PHYS, for example, which, like I said, had that small disparity compared to the others. This one's got 121 million on a weekly basis. On a daily basis there, we've got 21 million average daily dollar volume there. If we look at the AAAU, which is Goldman Sachs Physical Gold ETF, so you can see this has got 26 million, so slightly better on a daily basis, and 101 million on the weekly basis there, so a little bit better than the PHYS. And then what we've got there, SGOL, which is the Aberdeen Physical Gold shares, and this one's got 168 million on the weekly, and you can see 39.6 million on a daily basis. So this has got around double the PHYS, was it? Yeah, around double the PHYS, and it tracks better. So S-Gold, obviously backed by physical shares, tracks the gold, spot gold really well, as we can see here. So if we get back to the, you can see tracks the best tracking, only a 0.04 difference in that compared to spot gold over the last 200 days. You can see on a daily basis it's tracking pretty well. There are obviously periods where it gets out of alignment, but the Sprout physical gold is obviously the one that gets most out of alignment there. So in terms of actual ETFs to trade, this one, if you want to avoid the counterparty risk of trading GLD, then you would, especially with what's going on with the banking stuff at the moment, then you obviously want physically backed ETFs that are backed by physical gold. And so SGOL seems to be the one with the highest average daily volume. So that's kind of how I would approach that in that regard. So going back here at the moment, as I said, just in the potential secondary entry zone of the stage analysis method. So with this, we'll be looking for obviously a continuation attempt to start to move up and out into stage 2. If it fails here and starts to roll back over quickly, starts to move back below, then that would be yet another failed stage 2 attempt there. It would show significant weakness and would hence get out of the way very quickly. As failed attempts, as we saw before, once you get a failed attempt and it starts to break down, it can break down very quickly and you get a flush into stage 4. So yeah, move below 167 there, get out of the way in the GLD there, but we can start to push back above this 10-week moving average and start to move back towards the recent highs here, then potentially we could be on for a stage 2 continuation. So let's move on to the next. Let's talk about what's been going on with the bank stocks this week. So there are multiple different bank indexes that you can look at. So SVB obviously collapsed this week. It's had a contagion effect across the market, as well as obviously especially in the banking stocks and financial stocks. There's over 400 stocks in the bank group alone. So it's a massive group, and so there's many different indexes that track it. This bank index here, I believe, is the NASDAQ bank index. This has around 300 stocks in it almost. So this is a fairly good proxy of what's going on. You can see we've had a stage 4 continuation breakdown attempt here after we moved into stage 4. Started to turn back into potential stage 1 here, but continued to make lower highs and has rolled over again and now making a stage 4 continuation attempt. So if you're doing it from Stan Weinstein's ideal short, once it come from a stage 3 top, started to roll over. You've had the stage 4 breakdown area, started to roll over, and then it's made a secondary base structure. And this would be what he would mark as the C entry area on his ideal short sale, I would say. As obviously once you get a failed stage 1 attempt, obviously it can move quickly into stage 4. Doesn't mean we're going to flush all the way. We've got no idea what's going to happen with these. We could have there's bailout attempts going on as I record this at the moment. So we could actually see the opposite, and we could see a bounce suddenly if someone comes in and buys up the assets and confidence is restored quickly. But again, doesn't mean the price action itself has done a lot of damage to a lot of these stocks. So even if we do get a bounce, would expect, if it does manage to bounce back up, we would expect obviously a retest and a follow through potentially to the downside in these, as it's going to take a lot of time to recover some of the damage that's been done to some of these bank stocks this week. So this one looks a little bit worse than some of the others. If we look at the BKX, for example, this is designed to track the performance of the leading banks. So this only covers 24 banking stocks of large US national money centers, regional banks and thrift institutions. So you can see it's not as bad as the NASDAQ bank index here, which covers a much larger spectrum of banks, a lot more of the smaller names in that one. You can see it's broken down, still a stage 4 breakdown attempt here. Hasn't yet completely cleared the bottom of the structure here, but obviously testing the lower end, so it's in the weaker part. So again, if it can manage to rebound, you'd be looking for a secondary short entry point back up into the previous zone of obviously resistance support here. If it starts to move back up into there, then potentially if you're looking to short, you'd be looking in this kind of area. But relative strength, obviously exceptionally weak. Another one, BIX. This covers the S&P bank index. As you can see, still holding up in the stage 1 base structure here. Has broken the most recent low, but obviously this covers, I believe, the larger institutions. So less damage in these at the moment, but minus 11.54% weak nonetheless. So what are some of the ETFs that cover these? You've got KRE, so the Spider S&P Regional Banking ETF. So this was hit quite hard, 16%, minus 16% down, weakened stage 4, continuation breakdown attempt on heavy volume. So again, same principle. If it doesn't immediately continue down, then we'd be looking to obviously short on the rebound attempt for the secondary entry point in the method to form. But obviously at the moment, it's way past the stage analysis short entry point. On the KBE, this is another a Spider S&P Bank ETF. You can see this one, again, attempting to make a stage 4 continuation breakdown attempt, broken some more recent levels, but hasn't yet completely broken down. Again, a little bit potentially extended in the short term here. So be looking for some kind of rebound to then obviously look for a continuation attempt on the downside, so into old support resistance area. So what can you use if you are interested in shorting some of these bank stocks, ETFs? Obviously, individual stocks can be very, very tricky. As I said, there's a huge amount of them, and you could get obviously a lot of gappy type behavior. So ETFs are a potential, obviously, lower risk way to do it. There are leveraged ETFs which you can use, such as the FAZ here, which is the daily direction daily. They're 3 times, so tracks it 3 times leverage on this one. There are 2 times and 1 times ETFs as well, which I'll show you in a sec. But this one, you can see, had a plus 28.83% week here. Don't really need to. When you're using the leveraged ETFs, we don't consider stage analysis as much because obviously they have disparities in how they calculated. So you look at the major index to do the stage analysis. We're looking at these indexes here, the 1 times. You can see obviously we're making stage 4 breakdown attempts. So if you look at the inverse, it doesn't matter that this still looks like it's in the middle of a big stage 1 base. Obviously the actual indexes themselves are up here and doing this. So you don't do stage analysis on the 3 times, but you can use them obviously as a short-term trading tool. You should never use them as a long-term tool, as obviously the costs, etc., erode it over time. And you can see obviously attempts to move are very short-lived for the most part in these. So definitely a day trading or a swing trading tool if you're using these leveraged ETFs. So FAZ is one way you could potentially play the downside if you are attempting to short. SKF, another one that's a much smaller ETF. You can see the volume on the FAZ here is 28 million compared to 1.14 on the SKF here, which is I believe this is a 2 times ETF. So again, similar, we don't do stage analysis on this. Obviously it's just a tool that you would use to short. You would do the stage analysis on the actual index itself. So, and a 1 times is SEF here that you could potentially use if you wanted a lower risk way to do it. Again, volume's not great on this one, low 792 on that, but if we look at it on an intraday basis, it's still reasonably liquid, but you can see there's a lot of gappy behavior there, so not the best on that one. FAZ, for example, on a 5-minute chart here, much more liquid, so much better as a day trading or a swing trading tool for a few days. So let's go back.